Hello, and welcome to Boni's Life, the channel where we dissect the complexities of the global financial markets with the intellectual rigor they deserve. Today, we are staring into the abyss of a crypto market in free fall. Over the past 24 hours, we have witnessed a catastrophic collapse, a sea of red that has washed away billions of dollars and left investors reeling. The digital asset space is in full-blown panic, and the question on everyone's mind is, why? Mainstream media will feed you a simple narrative, a tech stock sell-off, a cyclical correction, but here we go deeper. We peel back the layers of misinformation and uncover the hidden catalysts, the non-mainstream discoveries that truly drive these seismic market shifts. In this episode, we will conduct a forensic analysis of this crypto apocalypse. We will not only show you what happened, but we will explain precisely why it happened and what is likely to happen next. We will dissect the fundamental forces and technical pressures at play, providing you with advanced insights and actionable intelligence that you will not find anywhere else. This is not just another market update. This is a masterclass in understanding the intricate dance of global finance. So buckle up, because we are about to embark on a deep dive into the heart of the storm. The numbers themselves paint a terrifying picture. The global cryptocurrency market cap has plummeted to $2.37 trillion, a staggering 7.2% drop in just 24 hours. Bitcoin, the supposed digital gold, has led the charge downwards, crashing below the critical psychological threshold of $70,000 to its lowest point since November 2024. As of now, it's trading at approximately $67,235. Marking an 8.9% loss in a single day and a devastating 20.6% loss over the past week. Ethereum, the second largest cryptocurrency, has fared even worse, down 9.3% on the day and a gut-wrenching 30.8% over the week, now hovering around the $1,950 mark. The carnage extends across the board, with major altcoins like BNB, XRP, and Solana suffering double-digit losses. This isn't a dip, it's a bloodbath. But the spot market is only half the story. The derivatives market, where the real high-stakes gambling happens, reveals the true extent of the panic. In the last 24 hours, we've seen a staggering $1.45 billion in liquidations, an almost 80% spike that has wiped out over 306,000 traders. The overwhelming majority of these liquidations, a massive $1.26 billion, were long positions, indicating that the market was caught completely off guard by the ferocity of this downturn. The fear and greed index has plunged to 11, a level signifying extreme fear. This is the market in full capitulation mode, a state of panic selling where logic is abandoned and survival instincts take over. Open interest has fallen by over 5% to $100.52 billion. A clear sign of deleveraging as traders rush to close their positions and reduce their exposure to this volatile environment. So what is the spark that ignited this inferno? The mainstream narrative points to a sell-off in tech stocks, and while there is a correlation, it is not the primary cause. The real catalyst, the event that has sent shockwaves through the institutional and professional trading world, is the nomination of Kevin Warsh as the next chairman of the Federal Reserve. On January 30th, 2026, President Trump announced his intention to replace Jerome Powell with Warsh, a move that has been interpreted by the smart money as a profoundly bearish signal for risk assets, especially cryptocurrencies. To understand why, you need to understand the man. Kevin Warsh is a hawk, the most hawkish of all the potential candidates for the Fed's top job. His public statements and past actions as a Fed governor reveal a clear preference for tighter monetary policy. He is a vocal proponent of shrinking the Federal Reserve's bloated balance sheet, a process known as quantitative tightening. For the past several years, cryptocurrencies have been a major beneficiary of the Fed's unprecedented liquidity injections. This fire hose of cheap money has fueled speculative bubbles across the financial system, and crypto has been one of the biggest recipients. Warsh intends to turn off that spigot. As Manuel Villegas Franceschi from the Next Generation research team at Julius Baer aptly put it, the market fears a hawk with him. A smaller balance sheet is not going to provide any tailwinds for crypto. Wash's nomination has effectively shattered expectations for further rate cuts. The consensus view now is that we will not see any meaningful easing of monetary policy until after September 2026 at the earliest. This is a dramatic repricing of risk, and it has sent institutional investors scrambling for the exits. The era of easy money that has propped up the crypto market is coming to an end, and the market is just beginning to wake up to this new reality. Adding fuel to the fire is the ongoing implosion in the technology sector. The so-called Claude crash, a reference to the AI-driven sell-off in software stocks, has created a contagion effect that has spread to the crypto markets. The correlation between Bitcoin and the tech-heavy Nasdaq has become alarmingly high. This is not a coincidence. The same institutional investors who have been piling into tech stocks have also been the driving force behind the recent crypto bull market, as they deleverage and reduce their risk exposure in the face of a potential AI-induced paradigm shift in the software industry. They are selling their crypto holdings in tandem. Weni Kai, the chief operating officer at Sin Futures, summarized the situation perfectly. That shift is directly impacting crypto prices. Bitcoin's move below the low $70,000 range has accelerated a broader deleveraging, flushing out crowded positioning built during the post-ETF rally. This is a crucial point. The launch of spot Bitcoin ETFs was hailed as a watershed moment for the industry, a gateway for institutional capital to flood into the market. And it was, for a time. But what the ETF evangelists failed to mention is that this institutional capital is fickle. It is not the hodl money of the early crypto pioneers. It is hot money driven by algorithms and risk models, and it will flee at the first sign of trouble. The data on ETF flows is damning. After months of massive inflows, the tide has turned. In January 2026 alone, we saw over $3 billion in net outflows from US spot Bitcoin ETFs. This follows outflows of approximately $2 billion in December and a staggering $7 billion in November. On February 4th, a single day, a massive 7,200 Bitcoin, worth approximately $485 million, was pulled from these funds. As analysts at Deutsche Bank noted, this steady selling signals that traditional investors are losing interest and overall pessimism about crypto is growing. The institutionalization of Bitcoin is a double-edged sword. It brings legitimacy and capital, but it also brings correlation to traditional markets and exposure to the whims of institutional sentiment. Now, let's turn to the charts and dissect the technical picture. The price action is, in a word, ugly. Bitcoin has decisively broken down from a bearish wedge pattern that had been forming between November 2025 and January 2026. This breakdown has sent the price hurtling towards the critical psychological support level of $70,000. As of this recording, we are hanging on by a thread. A sustained break below this level would open the door to a much deeper correction. The next key support level to watch is around $68,000. If that fails to hold, we could see a rapid descent to the major support zone at $60,000. In a full-blown capitulation scenario, a test of the $50,000 level is not out of the question. The Weekly Relative Strength Index, RSI, a key momentum indicator, has fallen to levels last seen in 2022, when Bitcoin was trading near $15,000. While this indicates that the market is deeply oversold, it is not a guarantee of an imminent reversal. In a bear market, assets can remain oversold for extended periods. On the upside, the path to recovery is fraught with resistance. The first major hurdle is the supertrend indicator, which is currently acting as immediate resistance at around $76,206. Even if we manage to reclaim that level, we would then face a wall of selling pressure in the 80,000 to 80,600 range. A break above that would be a significant bullish development. But it seems a distant prospect at this point. The bears are firmly in control, and any rallies are likely to be sold into until we see a fundamental shift in the macro environment. So, what can we expect in the next 24 hours? Based on the current market dynamics, I see three potential scenarios, each with a different probability. Scenario 1, the most likely in my view, with a 60% probability, is a bearish continuation. If we see a sustained break below $69,500 on high volume, It would signal that the sellers are not yet exhausted. This could trigger another wave of panic selling, with a target of $68,000 in the short term and potentially a slide towards $65,000. The relentless ETF outflows and the overwhelmingly bearish sentiment support this scenario. Scenario 2, which I assign a 25% probability, is a dead cat bounce. The market is extremely oversold, and the fear and greed index is at rock bottom. These conditions are ripe for a short-term relief rally, a bounce caused by short sellers taking profits and bargain hunters stepping in. In this scenario, we could see a rally back to the $76,000 to $80,000 resistance zone. However, I would view such a rally with extreme skepticism. It would likely be a bull trap, a temporary reprieve before the next leg down. Scenario 3, with a 15% probability, is a period of consolidation. The market could pause to catch its breath, trading in a range between $69,000 and $73,000 for the next 24 to 48 hours. This would indicate a temporary equilibrium between buyers and sellers as the market awaits its next catalyst, which will likely come from the direction of the US equity markets. For those of you who are actively trading this market, there are several key technical triggers to watch. A break below $69,500 is your signal for bearish acceleration. A reclaim of $72,000 could signal the start of a short-term relief rally. Keep a close eye on the RSI for any signs of bullish divergence, where the price makes a new low, but the RSI makes a higher low. This can be a powerful reversal signal. And of course, monitor the ETF flows. A sudden reversal from outflows to inflows would be a strong indication that institutional sentiment is shifting. And looking at the bigger picture, the analyst predictions are grim. Nick Pukrin of Coin Bureau has called for a bear market low in the $55,700 to $58,200 range. The analysts at Stifel have an even more dire prediction, with a target of $38,000 in an extreme bear case. The prediction market Polymarket is giving a 74% chance that Bitcoin will touch $65,000 at some point this year. The consensus view is that the crypto market will remain bearish until at least September 2026. There is one more factor that we need to consider, a ticking time bomb that could exacerbate the selling pressure: the Bitcoin mining crisis. With the price of Bitcoin hovering around $70,000, it is now below the estimated production cost of $87,000 for many miners. This puts immense financial pressure on the very people who secure the network. If the price remains at these levels or falls further, we could see forced liquidations from miners, who will have to sell their Bitcoin holdings to cover their operational costs. This would create a vicious cycle where miner selling puts further downward pressure on the price, which in turn puts more pressure on the miners. This is a market in turmoil, a market that is being reshaped by powerful macroeconomic forces. The nomination of a hawkish Fed chair, a deleveraging in the tech sector, and a crisis of confidence among institutional investors have created a perfect storm. The easy money has been made. The era of irrational exuberance is over. We are now in a new paradigm, a market where fundamentals matter, where risk is being repriced, and where only the most astute and well-informed investors will survive. Thank you for joining me on this deep dive into the crypto market crash. I hope this analysis has provided you with the clarity and insight you need to navigate these treacherous waters. Remember, in times of extreme fear, there is also opportunity. But that opportunity is only available to those who have done their homework, who understand the underlying dynamics of the market, and who have a clear and well-defined strategy. Don't forget to like, subscribe, and hit that notification bell so you don't miss our next episode, where we will continue to bring you the most advanced and intellectually rigorous analysis of the global financial markets. This is Boni's Life, signing off.